welcome. Thank you so much for joining us. As we've asked our clients what's on their mind, and the number one thing is volatility in financial markets. If we could just start at a high level, what are the main components that are creating or that we should be aware of if there's volatility in financial markets from your view?
Okay, well, thank you very much for the introduction, Nathan, and for the invitation to be here. So what I will do is to share my screen. It's often easier to have a look at some pictures, some charts to help you go through what I'm saying. So we've clearly, I think, had a very difficult period for markets. I mean, last year, both equities and bonds gave a negative return. And ultimately, what this comes down to is central banks. They have been raising rates, as we'll see in a second. This last year was the second most aggressive Fed tightening cycle in history. And our view is that that's likely to continue, that the market is pricing in that the Fed will be cutting rates in the second half. Our view is that inflation is not going to come down quickly enough for them to do that. So I think the bottom line and the argument that explains that we're likely to see continued volatility is that we see fairly clear signs now that growth is slowing, that the US economy and the global economy are entering recession. We shouldn't be too scared about recessions. They're a healthy thing, and they're not great if you get laid off, but they're a healthy way of cleaning the excesses from the economy.